Have you ever stopped to wonder if the absolute fastest path to wealth is really the best one?
Mm,
Or if maybe there's a quieter but maybe more powerful strategy actually at play?
that's a great question. It's something many people grapple with.
Well, today we're taking a deep dive right into that. Our mission really is to explore these different ways of building wealth.
Yeah, contrasting things like, say, the strategic advantage of patience.
Right, against the more high adrenaline world of active trading.
And we'll even touch on some, well, maybe less conventional routes too, stuff you might not expect.
Exactly. We're drawing on insights from the investor's patience advantage and the power of patience in wealth building. A great stack of sources, actually.
They offer a really fascinating look at how money truly grows, often in ways that aren't immediately obvious.
So think of this as like your shortcut to understanding the nuances here.
Mm-hmm.
We want to give you memorable details, practical takeaways you can use.
Let's do it. Let's unpack this.
So when we talk about successful investing, patience, it's not just a nice virtue to have, is it? It's more like a core strategy.
Oh, absolutely. It's a very active, very deliberate. It's not passive waiting at all.
How so? What do the sources say about how that advantage actually works?
Well, it's about how patient investors use cash. They don't just sit on it idly. They keep strategic reserves. They're waiting for the right moments.
So not getting swept up in the herd mentality or the latest hype.
Precisely. They exploit that herd behavior in a way. They understand that market swings often come from others being, frankly, irrational.
Right.
And having that cash, that dry powder, as they call it, lets them step in when everyone else is panicking or getting overly greedy.
And we have historical examples of this, right? The sources mention some big names.
Yeah, figures like Rockefeller, Warren Buffett, their stories really highlight this. Their massive wealth wasn't just luck.
It was strategic patience. Using cash when others couldn't or wouldn't.
Exactly. Buying when things looked bleakest or when an exceptional value popped up because they had the capital and the nerve to wait.
So what are the core benefits then, beyond just buying low?
Well, a huge one is avoiding those impulsive emotional decisions. Reacting to every little dip or surge.
That can kill your portfolio.
It really can. Patience provides a kind of shield. It lets you make more rational choices, buy quality assets when they're undervalued.
On sale, basically.
Right. And crucially, it lets you harness the power of compounding over the long haul. That's where the real magic happens for steady performance.
Compounding. It always comes back to compounding, doesn't it? It's like the secret sauce.
It really is. It's the engine of wealth growth.
Yeah.
You're not just letting your initial investment grow, but the returns on that investment start generating their own returns.
Like a snowball rolling downhill.
Perfectly put. And it works for more than just stocks, right? Think real estate, growing a business.
Mm-hmm.
These things need time to mature and appreciate fully. Patience gives them that time.
Okay, so patience helps avoid bad decisions, lets you buy low, and powers compounding. What else does it connect to, like market psychology?
Definitely. Understanding mass psychology is key. Patience lets you sidestep market bubbles when everyone's euphoric.
And avoid selling in a panic when everyone's terrified.
Exactly. You know when to hold cash because things are overpriced, and just as importantly, when to deploy that cash aggressively because assets are genuinely cheap.
Acting contrary to the crowd.
Yes, and that ability. It requires seeing opportunities that only patient capital can really access. It makes you wonder, doesn't it? How much does our own emotional control or lack thereof really cost us financially?
That's a sobering thought. Leaving money on the table because we can't handle the emotional swings.
The sources suggest it's significant. Patience fights fear, it fights greed, it fights that social pressure to do something now, allowing for those truly strategic wealth-building moves.
Okay, so the power of patience is clear. It's strong, it's strategic. But let's be real, it's also slow.
It generally is, yes. That's the nature of compounding.
And the allure of getting rich quicker. Well, it's undeniable, isn't it? Not everyone wants to wait decades.
Very true. And our sources acknowledge this. They dive into some of those faster lane strategies, too.
Right, here's where it gets really interesting. Options trading comes up.
It does. Specifically, they look at a strategy called the bear call spread.
Okay, break that down for us. What exactly is that? Options can seem complicated.
They can be, but the concept here is relatively straightforward. An options contract gives you the right, not the obligation, to buy or sell something, like a stock, at a set price by a certain date.
Okay.
A bear call spread is a specific play. You're essentially betting that a stock won't go above a certain price.
So you're bearish, Or at least not bullish.
Exactly. You do it by selling a call option at one price, let's call it the lower strike, and at the same time, you buy another call option at a higher strike price.
And why do that?
The main reason is you collect money, a credit, up front from selling that lower strike call. If the stock stays below that lower strike price when the options expire, you keep most of that credit as profit.
Okay, so you profit if the stock stays flat or goes down slightly.
Or even if it goes up a little, just not too much. It's a defined risk, defined reward strategy.
And the sources give an example of the potential profit, right? Something quite quick.
Yeah, they mentioned making, say, $36.40 from just one contract, which might not sound huge.
But then they scale it up. If you did 10 contracts, suddenly that's $364 in a day. That sounds pretty appealing.
It does. The temptation for those quick wins is definitely there.
But there's always a catch, isn't there?
Always. And the sources hammer this home immediately. Consistent success in options isn't about getting lucky or just betting big.
It needs more.
Much more. It demands a really clear, disciplined strategy. And critically, it needs to be backed by what they call quant research.
Quantitative analysis, data-driven stuff.
Exactly. Solid data, mathematical models, probabilities. Not just hunches or hoping you're right. You need an edge.
They even mention a resource, the Super Investor Club, as an example of where to get that kind of data-backed approach.
Yes, highlighting things like weekly lessons, resources, even live trade signals, emphasizing that rigorous analytical foundation over just speculating.
Okay, so discipline and data are crucial. And speaking of needing a plan, they share this great story, the bear call spread roller coaster.
Ah, yes, the $10,500 surprise. That's a good one.
So set the scene. An investor puts on a bear call spread.
Right, feeling confident in their analysis that the stock wouldn't rise too much.
And then boom, one day before expiry, they check their account and suddenly they're up $10,500.
Sounds great, right? But it wasn't quite that simple. What actually happened was assignment.
Assignment, what's that?
Remember, they sold that lower strike call option. Well, the stock price went above that strike price, so the person who bought the call exercised their right to buy the shares at $105. But our investor didn't actually own the shares to sell. This automatically forced them into a short position. They now owed 100 shares they didn't have.
Ouch. So they have to buy them back at the higher market price.
Exactly. The $10,500 wasn't just free money, it was the credit from the spread. But now they had this urgent problem. A short stock position in a rising market, that's dangerous.
So high-pressure situation, what did they do? What were the next steps?
They had to act fast. First thing next morning, buy 100 shares of the stock to cover that short position, to get back to flat.
Stop the potential bleeding if the stock kept rising.
Precisely. And then they also closed out the other leg of the spread, the call option they had bought, to completely exit the trade and eliminate any further risk.
Wow. Okay, so they managed it. But the sources then explore the what-ifs, right?
Yeah, and this is really instructive. Like, what if they'd waited, hoped the stock price would drop before they bought the shares to cover?
Could have made more profit if it did drop.
Potentially, yes, that's the pro. But the con, oh boy. If the stock kept climbing, those losses on the short position could have ballooned incredibly fast. Huge stress, potentially catastrophic losses.
Not worth the risk, probably. What about the other what-if? Not closing the buy call immediately.
Right. The thinking might be, well, if the stock keeps going up, my buy call will gain value, giving me a cushion. That's the pro.
Not the con.
If the stock flattened out or fell, that buy call would just lose value rapidly due to time decay as expiry approached. It essentially turns risk management into more of a gamble.
So it really highlights the need for a clear exit plan before things go sideways.
Absolutely. The ultimate lesson they draw is crystal clear. The best defense is to understand exactly what you hold, have a plan ready, and manage the trade rather than leaving it to chance.
It really underscores that need for deep knowledge and discipline, even maybe especially in these faster strategies.
It does, and it highlights the psychological toll, too. The constant monitoring, the stress. It's not for everyone, even if the potential profits look good on paper.
Okay, so we've got the slow, patient path and the fast, demanding path of active trading. Let's widen the view a bit. Our sources also mention other ways people build wealth, right? Some less conventional ideas.
They do. It's not all stocks and options. They touch on things like, well, the classic saving versus investing debate, or flipping properties versus holding them long term.
Generally reinforcing that slow and steady idea again.
Often, yes. But also looking at modern avenues, like building a YouTube channel in 2025.
Ah, the creator economy. How does that fit in?
Well, the sources frame it as turning content into a potentially passive income stream. But it's not magic. It requires a playbook, consistency.
Like building any asset, really.
Yeah.
Consistent effort over time.
Exactly.
Mm.
Your content becomes the asset, your audience compounds. It's a different kind of compounding, but the principle holds. Consistent quality and engagement can lead to growth from ads, sponsorships, products.
It's that slow and steady discipline, again, just in a digital context. Interesting.
Then there's the Rich Reads Real Wealth segment looking at the film The Social Network.
Ah, the Facebook movie. What's the wealth lesson there?
It's really about the messy reality of tech startups, the ambition, the innovation, but also the broken friendships, the legal fights.
Yeah, it wasn't a pretty picture in parts.
No. And the takeaway is how easily ambition can clash with ethics and relationships. Success, especially rapid success, can have really high non-financial costs.
So the action step is,
Balance ambition with integrity. Your reputation, your relationships, that's a form of capital too, maybe even more valuable long-term. It's about the whole architecture of wealth, not just the bank balance.
that's a powerful point. And finally, there was this really intriguing bit, diamonds in the dumpster.
Haha, yeah. It sounds a bit crazy, but it's not necessarily literal.
Okay,
It's more a metaphor. The idea that real financial opportunities, real value, might be hiding where nobody else is looking in things others discard or overlook.
like finding value where everyone else just sees trash.
Essentially, yes. It could be a struggling business, an overlooked niche, an unconventional investment. It's about seeing potential where others see problems.
So it connects back to that contrarian thinking we talked about with patient investing.
Absolutely. It's about critical thinking, questioning assumptions about where wealth should come from. It really prompts the question, how often do we miss great opportunities just because they don't look like what we expect them to look like?
Because they aren't neat or tidy or conventional.
Exactly. It's about finding arbitrage in everyday situations, looking deeper.
Okay, so we've covered a lot of ground here. From the quiet strength of long-term patience
Exploiting market psychology, leveraging compounding.
to the high-octane world of options trading where data and discipline are absolutely everything.
Right, managing risk minute by minute almost.
And then these other paths, building digital assets like a YouTube channel, learning from the complex ethics of startup culture.
And even just training ourselves to look for value in completely unexpected places, the dumpster diamonds.
So when you pull it all together, what's the common thread? What's the big takeaway for someone listening?
I think the core message, really, that comes through from all these different angles is this. It doesn't matter so much if your path is slow and steady or fast and agile.
Okay.
What matters is having a strategy. It's about discipline, controlling your emotions, and truly deeply understanding what you're doing.
Knowledge is power, basically.
It's more than power, it's the ultimate investment itself. Applied knowledge with foresight and self-awareness, that's what builds lasting wealth, regardless of the specific vehicle.
It's a good reminder. Fast moves can seem exciting, maybe even feel productive.
But the evidence often suggests slow, steady, strategic steps win out over the long term.
The real goal, then, across all these ideas, whether it's compounding interest, building content, or finding hidden value, it's about building momentum, right?
Yeah.
Unstoppable momentum.
Well said. That's the aim.
So, as you, listening, think about your own path, your own wealth journey, maybe consider this. Which one of these ideas we talked about today, maybe one you hadn't really thought about before, might you start exploring? And what hidden opportunities, what diamonds might you uncover if you just look a bit deeper, cultivate a little more patience, or perhaps just question what everyone else assumes is valuable?